Welcome to this comprehensive guide on technical analysis for cryptocurrency trading. Technical analysis is one of the most powerful tools traders use to make informed decisions in the crypto market. In this video, we'll explore the essential chart patterns and technical indicators that can help you identify profitable trading opportunities. Whether you're just starting your trading journey or looking to strengthen your analytical skills, this guide will provide you with the foundational knowledge you need to analyze price movements and predict market trends effectively. Technical analysis is the practice of studying historical price movements to predict future market trends. Unlike fundamental analysis, which focuses on the intrinsic value of an asset, technical analysis examines charts, patterns, and statistical indicators. The core principle is simple. Price movements tend to follow recognizable patterns that repeat over time. By analyzing these patterns, traders can identify potential entry and exit points for their trades. Technical analysis also involves recognizing recurring formations on price charts that signal trading opportunities, such as trend reversals or continuations. This method has been used successfully across all financial markets, including stocks, forex, and cryptocurrencies. Reversal patterns are chart formations that signal a potential change in the current trend. These patterns are crucial for identifying when an uptrend might reverse into a downtrend or vice versa. The head and shoulders pattern is a bearish reversal pattern that appears after an uptrend. It consists of three peaks, with the middle peak being the highest, resembling a head with two shoulders. This pattern suggests that the upward momentum is weakening and a downtrend may follow. The double top is another bearish reversal pattern where the price reaches a high point twice but fails to break through, indicating strong resistance and a likely price decline. Conversely, the double bottom is a bullish reversal pattern that forms after a downtrend, where the price hits a low point twice and then reverses upward, signaling potential gains ahead. Continuation patterns indicate that the current trend is likely to continue after a brief pause or consolidation. These patterns are essential for traders who want to ride existing trends rather than trying to predict reversals. Triangle patterns form when the price consolidates between converging trend lines, and they typically signal that the trend will resume in its original direction. Flag patterns appear as rectangular-shaped consolidations that slope against the prevailing trend, often occurring after strong price movements. They suggest a temporary pause before the trend continues. Pennant patterns are similar to flags, but have converging trend lines that create a small symmetrical triangle. Finally, rectangle patterns form when the price moves sideways between horizontal support and resistance levels, eventually breaking out in the direction of the previous trend. Candlestick patterns are powerful visual tools that provide insight into market sentiment and potential price reversals. Each candlestick shows the opening, closing, high, and low prices for a specific time period. The hammer is a bullish candlestick pattern that appears at the bottom of a downtrend. It has a small body and a long lower wick, indicating that buyers rejected lower prices and pushed the price back up. This pattern suggests a potential trend reversal to the upside. The shooting star is the opposite, a bearish pattern that appears at the top of an uptrend with a small body and long upper wick. It shows that sellers rejected higher prices, signaling a possible downward reversal. The doji is a unique pattern where the opening and closing prices are nearly equal, creating a cross-like shape. It represents market indecision and often signals that a trend reversal or continuation may be imminent. Technical indicators are mathematical calculations based on price, volume, or open interest data that help traders analyze market conditions and make informed decisions. These indicators fall into three main categories. Trend indicators help identify the direction and strength of market trends. They answer the crucial question: is the market trending upward, downward, or moving sideways? Momentum indicators measure the speed and magnitude of price movements. They help traders understand whether a trend is gaining or losing strength, and whether an asset is overbought or oversold. Volume indicators analyze trading activity and market participation. Volume is a critical component because it confirms the validity of price movements. High volume during a price increase suggests strong buying interest, while high volume during a decline indicates strong selling pressure. Let's explore the most popular trend indicators used by traders worldwide. Moving averages are the foundation of trend analysis. They smooth out price data by calculating the average price over a specific period. The simple moving average, or SMA, gives equal weight to all prices, while the exponential moving average, or EMA, gives more weight to recent prices, making it more responsive to new information. The MACD, which stands for Moving Average Convergence Divergence, is a powerful indicator that shows the relationship between two moving averages. It helps identify trend changes, momentum shifts, and potential buy or sell signals. Bollinger Bands consist of a moving average with two standard deviation bands above and below it. These bands expand and contract based on market volatility, helping traders identify overbought or oversold conditions. Finally, the DX, or Average Directional Index, measures the strength of a trend regardless of its direction. A high DX reading indicates a strong trend, while a low reading suggests a weak or ranging market. Momentum indicators are essential tools for understanding the speed and strength of price movements. The RSI, or Relative Strength Index, is one of the most widely used momentum indicators. It measures the magnitude of recent price changes on a scale from 0 to 100. Readings above 70 typically indicate that an asset is overbought and may be due for a pullback, while readings below 30 suggest oversold conditions and a potential bounce. The stochastic oscillator compares a closing price to its price range over a specific period. It helps identify turning points by showing when an asset is overbought or oversold relative to its recent trading range. The ROC, or Rate of Change indicator, calculates the percentage change in price over a specified period. It's a simple but effective tool for measuring momentum and identifying potential trend reversals. Positive ROC values indicate upward momentum, while negative values suggest downward momentum. Support and resistance levels are among the most fundamental concepts in technical analysis. These are specific price levels where the forces of supply and demand meet, creating barriers that are difficult for prices to break through. Support is a price level where buying pressure is strong enough to prevent the price from falling further. Think of it as a floor that holds the price up. When a price approaches a support level, buyers step in because they perceive the asset as undervalued at that price, creating demand that pushes the price back up. Resistance, on the other hand, is a price level where selling pressure prevents the price from rising further. It acts like a ceiling. When prices approach resistance, sellers become active because they believe the asset is overvalued, creating supply that pushes the price back down. These levels are crucial because they help traders identify potential entry and exit points. When a support level is broken, it often becomes a new resistance level, and vice versa. This phenomenon is known as role reversal and is a key principle in technical analysis. To maximize your success with technical analysis, follow these essential best practices. First, always use multiple timeframes when analyzing charts. Looking at different time periods gives you a complete picture of market conditions. For example, the daily chart might show an uptrend, while the hourly chart reveals a short-term pullback, helping you time your entries more precisely. Second, combine multiple indicators rather than relying on a single tool. Different indicators complement each other and provide confirmation. For instance, you might use moving averages to identify the trend, RSI to spot overbought or oversold conditions, and volume indicators to confirm the strength of the move. Third, always confirm price movements with volume data. Volume validates price action. A price breakout with high volume is much more reliable than one with low volume, which might be a false signal. Finally, practice proper risk management. Set stop-loss orders to limit potential losses, and never risk more than a small percentage of your capital on a single trade. Position sizing is critical to long-term success. Remember, technical analysis is not about predicting the future with certainty, but about improving your probability of making profitable trades by understanding market behavior.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.